Hello, my friends. Today is January 4th, and this is Markets Weekly. So, this past week, we had a bout of volatility in the markets, but at the same time, it was a shortened holiday trading week, so I'm not sure if I'd read too much into it. So, today, let's talk about something a bit more thematic and a bit more appropriate to the upcoming trade war, because that is coming. So I came across the work of Michael Botes, who is a professor in China who specializes in global trade and China in particular. Now, Michael has a very interesting perspective based on his recent writings that he thinks that tariffs would actually be good for the US, whereas it would increase GDP in the US and also employment. Now, reading more into Battista's perspective, and thanks to Andy Constant for tagging this extensive piece from Michael Battista, I came away with the impression that Michael shares the same perspective of the incoming Trump administration based on writings of incoming Trump officials. So I think it's helpful to understand this perspective in anticipation of what may be to come. So that's all we're going to talk about today. But before we begin, let's level set a little bit. So if you were like me and you studied economics in school, you would have come away with the conclusion that trade is good, period, the end. So once upon a time, there was a very influential thinker by the name of David Ricardo. Now, David Ricardo had this idea of comparative advantage, whereas each country is relatively better at producing one thing than the other when compared to other countries. And so when they trade with each other, both countries are better off. Let's say Saudi Arabia, for example, big country, mostly desert, but has a lot of oil. So if they were to grow corn, it'd take a lot of water, which they don't have a lot, take a lot of resources, and they probably wouldn't grow a lot. In contrast, it'd be much easier for them to dig for oil compared to spending resources to grow corn. Now, looking at another country, France, for example, has a lot of good agricultural land. It'd be easy for them to grow a lot of corn, a lot of wheat, and so forth. But as far as I know, they don't have a lot of oil there. So if they were to try to produce oil, it'd take a lot of resources to try to find oil, and they probably wouldn't produce all that much. It'd be very, very expensive to produce that. Now, suppose these two countries traded with each other, what you would end up seeing is Saudi Arabia specializing in producing oil and France specializing in producing agriculture goods, and these two countries trading with each other, such that at the end of the day, Saudi Arabia would have more oil and more agricultural products than they would if they didn't trade with anyone, and France would have more oil and more agricultural products than they would if they didn't trade with anyone. So both countries would be better off. Now, of course, you would have some distributional consequences to this, like if you were a farmer in Saudi Arabia or if you are an oil worker in France, you guys would be out of work and have to find work elsewhere. But the government could also tax and redistribute some of the profits in the winning industries to help compensate the losing industries. But at the end of the day, overall, the countries would be better off. Now, that's a theory, and that's why you're taught that trade is better, period, at the end. And in practice, you see a little bit of that in real life. For example, in the US, when we trade, we do have a lot of cheaper manufactured goods. The manufacturers did lose their jobs, but they also receive some benefits from the government. Of course, I'm not very generous. So, kind of worked like that in real life. But Michael looks at the data on a more global scale and realizes that there's something very important where it did not actually work as predicted. Now, looking at this chart, you can see that some countries, like the US, have chronic current account deficits, and other countries, like China, have chronic current account surpluses. And what that means is that the US is always buying more from abroad than it's selling from abroad. And some countries like China are always selling more goods and services abroad than they are importing from abroad. Now, that is kind of something that shouldn't happen because you would expect that over time, these trade imbalances to balance out. Now, in the time of David Ricardo, they were under the gold standard, right? So you would expect, let's say, if we were under the gold standard, that as the US ran these chronic current account deficits, gold would flow out of the US and into China. That would mean less gold, less money in the US. US prices would deflate, more gold, more money in China. You would have an inflationary phenomenon. So as goods in the US became cheaper and they became more expensive in China, then the Chinese would buy more goods from the US, and you would have that money would flow back from China into the US, and these trade relationships would equilibrate. In a fiat system, you would expect something similar with currencies, where the RMB would appreciate, things would become cheaper uh, in RMB terms. So it'd be cheaper for Chinese companies to buy stuff from the US, and again, trade relations would equilibrate. But obviously, that's not what's happening here. We have these chronic trade imbalances. And so the system is not working as predicted. And what you end up is a lot of people in the US who basically don't have jobs anymore. Like in a basic framework, you would expect these people to go and migrate to industries where the US has a comparative advantage at. Let's say, looking back into the Saudi Arabian oil case, you would expect all the farmers there to go and become oil workers. And again, there's not that equilibrium. Now, Michael is looking at this and he thinks that it's a couple reasons for this. One is that the US is a very desirable destination for capital. So we have Nvidia, we have a very deep and liquid treasury market and so forth. So what ends up happening is that as foreigners are making a lot of money, again, selling goods to the US and ending up with a lot of dollars, rather than using that to buy goods and services from the US to equilibrate the trade relationship, what they're actually doing is buying a whole ton of financial assets in the US, which again are highly desired. Another reason he thinks that this is not equilibrating is due to the industrial policies of countries like China, where the Chinese system is very different from the US, where they kind of have a strong uh, interventionist stand from their government. For example, if their government wanted to build a successful EV industry, which they have, the government can pour a lot of subsidies into these sectors to make them very competitive, much more so than the free market could produce. Now, an example of this could be, for example, trying to peg your currency so that it is chronically undervalued so that your exports are cheaper. It could be offering cheap loans to certain industries. Obviously, in China, the government controls the banking sector, so they could heavily subsidize one industry if they wanted to, and they do that. It could be rewriting the regulations so that it's easier for companies to produce in China cheaper. For example, one thing that we all know is that the environmental regulations there are laxer than they are in the US, for example. And so that is a cost advantage that manufacturers have over there. It could also be things like labor laws, which are not as strong there, and oftentimes the government, through a special system, limits internal migration to some extent. So in China, because industrial policy strongly favors manufacturing and in a sense, subsidizes it by kind of keeping a lot of the public very poor, uh, the Chinese have a chronic, persistent advantage when it comes to manufacturing that they are able to deploy throughout the world. So, if you have the government constantly subsidizing this, then that's another reason why it wouldn't equilibrate. Now, this is kind of a problem in the US because for chronic importing countries like the US, because that means that even though Americans get cheaper household goods, that is actually paid for by higher unemployment from the people who lost out to trade. And because the trade relationship can't equilibrate, these guys are basically stuck. So some other interesting things that Michael addresses is that some people think that this is a natural evolution of an economy. As you become wealthier, you become more services oriented, and the goods stuff, you just can't compete with that. It's a natural transition. But Michael also points to countries like Germany and South Korea, which and relatively wealthy countries, but still have a very high share of manufacturing. Uh, and of course, if you have all these unlevel playing field due to government policy, government industrial policy, it's very difficult for um, industries outside who don't have the same subsidies to compete. So this again becomes a very difficult problem. Now, In this context is why Michael thinks that if we have tariffs, it could actually be good for the US. Because if that is the problem, that we have this chronic trade imbalance that can't balance due to the intervention of the government, then we could also do things to try to even the playing field, and that would be tariffs. Now, if we were to do tariffs, of course, you would kind of be doing the same thing that these other countries are doing. The U.S. would intervene. There'd be more government policy. Imports would become more expensive, and force, well, actually, will make U.S. manufacturing more competitive, and in a sense, redirect resources towards manufacturing, and maybe. By forcing this, we would have a more balanced trade relationship. Of course, Chinese export sectors would suffer, but the US manufacturing sector would benefit. At the end of the day, you would have more growth in the US over time because you would have more production. Manufacturing would increase in the US, and you could also have more employment. As more people worked in manufacturing, of course, the US households would face higher prices. And as we noted earlier, Chinese companies would suffer. That is one solution to this, and a solution that the Trump administration has been trying to pursue and will continue to pursue. It's very clear. Another interesting idea that Michael floats is capital controls. So again, the Chinese foreign companies are making a lot of dollars, but rather than using that to buy goods and services from the US to equilibrate the trade relationship, they're buying a lot of US financial assets. One way that we could stop them from doing this is to have capital controls, and this could come in the form of very blunt things like just not letting foreigners buy US assets, or it could come through, I guess, softer things like taxes. Let's say foreigners have to pay an additional capital gains tax or income tax for dividends and things like that. So to discourage foreigners from buying US financial assets. That could also force them to use their dollars and maybe spend more on goods and services. Now, the downside, the problem to that, of course, is that in the US, that would tank the capital markets, tank the equity markets. Many rich people don't like to see them. They're very influential. And it would also be a problem for the corporate as well as the foreign policy establishment. The foreign policy establishment uses sanctions as a major soft power tool. Again, you can do a lot of things with sanctions without having to break out the guns and the nukes and so forth. And that's what they tried with Russia. Now, if we were to have more capital controls, the dollar probably wouldn't be as influential as it is now. That decreases the power of the foreign policy establishment. And of course, corporations and banks are heavily benefiting from these free flows of capital, being able to, again, do deals and shift money throughout the world that would not be as easy in a capital controls framework. And so they would lose as well. So that's not something that I hear the Trump administration talking about, but of course, it's definitely a possibility down the line. I have heard some slight whispers, but not very prominent. So I don't think that will happen. But this framework, I think, is the framework that's going to be adopted by the Trump administration when they come and they do their vision in transforming the U.S. So I think tariffs are definitely going to happen, and they're probably going to happen as a structural way, something that's going to be used not just for negotiation, which it will be used for negotiation, but I think structurally it's something that's going to be persistent because they want to do this huge reshaping of the economic order. And so I'm going to leave links to the pieces that I referenced below, so definitely worth a read. I think there's some conceptual errors when it comes to the monetary aspect of this, but that's not his specialty. But in any case, that's all I prepared for today. Thanks so much for tuning in.